Hi, my name's Eric, and I'll be reading you selections from Barrons magazine with an issue date of July 7th of 2025. This is produced by the Audible Local Ledger, a reading service for people who are blind or print disabled. We'll start, as we always do, with Up and Down Wall Street. This is by Andy Serwer. Are you ready for yet another American Revolution? Bristol, Rhode Island bills itself as America's most patriotic town. Mostly, it seems, by virtue of hosting the oldest continuous celebration of the 4th of July, beginning back in 1785. For history buffs, this year's July 4th is no ordinary one, as it's partly a marker in the countdown to next year's big anniversary, America's 250th. As you might imagine, the good folks at the Massachusetts Historical Society are already in full commemoration mode. Paul Revere's ride in the battles of Lexington and Concord and Bunker Hill took place in the first half of 1775, as is documentary filmmaker Ken Burns, whose 6-part, 12-hour series, The American Revolution, premieres in November. The 8-year slog of our Revolutionary War of 1775 to 1783, while certainly the most momentous, is hardly the only rebellion in America's history. Besides the nearly catastrophic Civil War, our nation has endured the Shays and Whiskey rebellions, Nat Turner's slave revolt, the occupation of Alcatraz, and many more. And this doesn't even include rebellious political movements like the Progressive Era, the Great Society, or the Reagan Revolution. And now we're being buffeted by new waves of political dissent and counter-dissent, manifested perhaps by President Donald Trump's big beautiful bill on the right and the Democratic primary triumph of New York mayoral candidate Zohran Mamdani on the left. One passed by the Senate, the other declared the winner within minutes of each other this past Tuesday. Revolution may be in the air right now, as Bob Dylan sang in Tangled Up in Blue, but revolution is also as American as apple pie. It was a revolution that began us, says noted American historical author Nathaniel Philbrick, and it continues. The nation will always feel like we're on the edge of a catastrophic change that will ruin us all. That may happen at some point, but it kind of goes with the territory. Before delving into this latest fervor, we should note that besides commemorating America's birthday, the parades, orange crate derbies, and fireworks also usher in the beginning of the high summer season, none of which lends itself to deep thinking when it comes to money and markets, and yet one should be wary of watching the butterflies instead of tending to the garden at this juncture. Though it may pale in comparison to the first 6 months of 1775, we did brave Liberation Day, California wildfires, Doge, Taco, a bond rout, and a bombing of Iran in the first half of 2025. And yet, the S&P 500 index climbed 5.5%, strikingly in line with annualized historical norms, which, with all the worry wart spouted, is pretty good. And as Elvis Presley, an American revolutionary if there ever was one, said, a little less conversation, a little more action is what counts. Going forward, as if you needed another reminder that sell in May and go away is hooey, Jonathan Krinsky, an analyst at BTIG, writes that July has been the best performing month over the past 20 years, up 2.79% on average, including 10 straight Julys higher, while the NASDAQ composite was up 16 straight Julys before last year's 1.68% loss. There are fundamental reasons for optimism, too, even with the U.S. dollar headed the way of Davy Jones's locker and U.S. consumer spending declining 0.3% in May, based on real PCE, or personal consumption expenditures adjusted for inflation. The bull's case is simple. Positive reports from the likes of CarMax, Coinbase, JP Morgan Chase, Micron Technology, Walt Disney, and Oracle, all June stock market stars. Count more. As for other indicators, the June jobs report is of interest mostly in that it could spur Trump to either demand that Federal Reserve Chair Jay Powell cut rates in July or demand the Fed chair's head. And that brings us back to revolutionary impulses, as a Fed chair cannot be summarily dismissed by a president except for cause, according to the Federal Reserve Act. And it never occurred going back to the very first Fed chair, Charles Hamlin, of 1914 through 1916. Still, it seems clear that Trump, who has railed against Powell for not cutting rates, would love nothing more than to see the Fed chair decamp. Right now, though, the president is consumed with his tariff deadline on Wednesday and the big, beautiful bill, which he initially hoped to sign, patriotically, we suppose, on July 4th. The market now sees less than a 5% chance of a trim at the Fed's July 29th and 30th meeting. Countering Trump's machinations is an insurgency unfolding in New York City, in which Democratic Socialist Zohran Mamdani appears poised to become the city's next mayor. Predictive market Polymarket gives him a 70% chance of winning in November. Mamdani, who's 33 years old, a sartorial-inclined state assemblyman from Queens, defeated former New York Governor Andrew Cuomo, who's 68 years old, who resigned in 2021 after allegations of sexual harassment. Mamdani will face a Republican challenger and/or independents, including current Mayor Eric Adams, who last year was indicted on federal corruption charges that were later dropped. Mamdani, who has engendered overwhelming support from young and first-time voters, stands firmly aligned with his party's left wing, along with allies Alexandria Ocasio-Cortez and Bernie Sanders, which has Wall Street in a panic, according to the Wall Street Journal. It's officially hot commie summer, Dan Loeb, CEO of hedge fund Third Point, wrote on X. When asked to expound, Loeb didn't reply, nor did a number of other captains of New York industry, except for IAC chairman Barry Diller, who emailed me back saying he had nothing much to say about Mamdani other than, "I hope he loses." Assuming Mamdani doesn't lose, though, what exactly are his economic intentions? A quick peek at his campaign website with its striking mustard and cobalt tones and vintage Bollywood poster imagery lays it out front and center. Zohran Mamdani is running for mayor to lower the cost of living for working-class New Yorkers. Mamdani's plan includes, number one, freezing the rent for all stabilized tenants, detailed in a TikTok video where said candidate plunges into the freezing ocean in a suit. Did I mention this guy's a politician? Number two, constructing 200,000 new affordable housing units. Number three, creating a network of city-owned grocery stores. 4, making city buses free. Number 5, implementing free childcare for every New Yorker. And number 6, raising the minimum wage to $30 an hour. To pay for this, Mamdani would increase taxes on corporations and wealthy individuals, which he says will raise $5 billion and $4 billion respectively. Won't the companies and grandees flee? I don't think that there's much empirical merit to the idea that the top 1% or businesses are going to move in response to very marginal increases in their taxes, says Emily Eisner, chief economist at the Fiscal Policy Institute and one of a couple dozen or so progressive economists who signed a letter supporting Mamdani. Mamdani's corporate tax plan doesn't raise the rate above neighboring states like New Jersey. It's an enormous cost to move. Plus, the agglomeration effects of being in New York around lots of other businesses are so beneficial. As for high-income New Yorkers, past tax increases didn't really result in high earners leaving. Maybe. And then there's the old line, past performance is not an indication of future results. It'll be challenging for Mamdani to effect change. Tax increases, for example, need to be signed off by New York Governor Kathy Hochul, who has vowed not to do so. Still, never say never. How many times have Democrats insisted Donald Trump couldn't implement a policy, and he did? A charismatic figure shilling a revolutionary idea is a potent combination. As for billionaires who whine about Mamdani's agenda and suggest market forces should correct imbalances, I have two thoughts. First, deep-pocketed ones, consider why New Yorkers want a socialist mayor in the first place. And may I suggest you ask this question while taking a quick glance in the mirror. As for the latter, what is an election if not a market force? James Galbraith, an economist at the University of Texas and son of John Kenneth Galbraith, calls Mamdani's plan a sensible approach and appealingly realistic, and notes that socialists have played a part in American politics long before AOC, Bernie, and Mamdani came on the scene. Think Eugene versus Debs and Norman Thomas. But is it really possible that New York City could have a socialist mayor? It would hardly be the first, Galbraith says. There was LaGuardia. Oh yes, Fiorello LaGuardia, a socialist and Republican, not a typo, mayor of New York from 1934 to 1946, who defeated a Democratic machine candidate. LaGuardia, nicknamed the Little Flower, was 5 feet 2 inches tall in his Oxfords, rotund, irascible, charismatic, and fluent in Italian, Yiddish, German, and Croatian. He was also effective, oft cited as the best mayor in American history, and much loved. I recall my parents' faces lighting up, and they were hardly socialists, when they told me how he read the comics to children over the radio during a newspaper strike. LaGuardia built parks, playgrounds, subways, and an airport, and played a key role in expanding public housing, overseeing the creation of the New York City Housing Authority. He also supported taxes on luxury goods and a graduated income tax for those earning more than $100,000, which would be around $1.7 million today. Socialism had its day 80-odd years ago, and heaven knows it may soon again. Centrist Democrats argue Mamdani is a gift to the GOP, which he may be. His critics claim that he's far more left-wing than his socialist predecessors. His flame may also burn out. For now, at least, Mamdani has lit a fire in New York City and become a lightning rod, too. The New York Post put him on its cover 5 out of 7 days last week, and expect more between now and November. It's a pendulum, says Philbrick. Things build up to a crisis point, and then it takes a while, but eventually people say, whoa, that's too much, and then we go back. It's a jagged, messy, turbulent process of moving into the future that's full of all sorts of more revolutions. On this July 4th, more than ever, viva the American Revolution. Our next article from the Streetwise column. Investors in virtual farming are raking in real money, by Jack Huff. Fake farming has gone viral again. And this time, it has helped send Roblox stock 171% higher in a year. I'll attempt to explain. Warning, the following might be disturbing for Iowans, value investors, and the employed, especially 52-year-olds who used to wash dishes after school down at the old McCaffrey's Bar and Grill for their video game funds. Not like these boys today with their alpaca hairdos and their bruh and their pestering for Roblox money. Once there was a game called Farmville, and it too was a total waste of time. But it was popular and lucrative with a freemium model. Players could use virtual toil to earn in-game currency, which they could trade for farm resources. Or they could also spend real money to get premium goods in a hurry. Farmville launched on Facebook in June of 2009 and peaked within a year at more than 30 million daily users. It could have been even bigger had Facebook not been so slow to shift its focus to mobile phones. The original game was replaced with sequels, and its publisher, Zynga, parlayed its success into a 2011 initial public stock offering, and then in 2022 into a $12.7 billion buyout from Take-Two Interactive. Now forget about Farmville. Today it's all about Grow a Garden. The agricultural simulator launched on Roblox on March 25th, during something called National Farm Worker Awareness Week, as it happens. But that was by coincidence. Roblox is a platform for user-made games with simple Lego-like graphics. It's popular with kids for its social elements like group play and chat. Grow a Garden recently blew past the Epic Games shooter Fortnite to set a record for most users playing simultaneously at more than 20 million. Cumulatively, Grow a Garden has already been played more than 12 billion times. There are Roblox games that have been played more, but they took years to get where they are versus a few months for Grow a Garden. To date, there's arguably no other video game that's generated this type of engagement in such a short span of time, writes Barclays Capital analyst Ross Sandler. Alexis de Tocqueville wrote in his 1835 study, Democracy in America, almost all the farmers of the United States combine some trade with agriculture. He should have been a game developer. Grow a Garden players start small with, say, a patch of carrots, and can patiently work their pixelated land until they accumulate enough in-game currency, called shekels, to trade for fancier plants and pets. But the best stuff is rarely in stock. To gain access to it, players can instead spend Roblox's platform-wide currency called Robux. That one is bought with real money. JP Morgan estimates that Grow a Garden bookings or Robux purchases to date total $150 million, and that players spend an average of 6 cents per hour. The game's owners are now making an estimated $20 million a month. These include a 16-year-old known online as BMW Lux, who spent a week making Grow a Garden and who sold a stake in operational control in April after the game passed 1,000 simultaneous players. What matters now for investors is how long this digital farm boom will last and whether it will lure new Roblox users. How much of the increased winnings are priced into the stock? The answers appear to be not long, some, and too much. The 2009 Farmville craze subsided after a year or two, but produced a long tail of earnings after that. Roblox user growth is inflected higher since Grow a Garden launched, suggesting that the game is attracting new users and not just cannibalizing other Roblox games. That will add 4% to this year's company-wide bookings, Sandler at Barclays predicts. But the ratio of the company's value to its revenue has expanded by 72% since the game came out, leaving Sandler to conclude that the bonanza is more than priced in already. He rates the stock recently trading at 62 times next year's projected free cash flow at equal weight. Let's switch from Roblox to Crocs, mostly because they rhyme. B of A securities analyst Christopher Nardone writes that there's still a lot to like at 7.5 times earnings. Wait, what? A year ago, you could barely find a Crocsless teen foot. The brand had once stalled by expanding into too many footwear categories, but new management had refocused it on core rubber clogs with holes for plugging in high-margin decorative charms called gibbets. Teens embraced the ugliness and sales shot higher. Now shares have fallen 30% in a year. Go ahead and call the data police over this unnecessary comparison. Last year, Roblox and Crocs weren't too far apart on sales, approaching $4 billion for Roblox and more than $4 billion for Crocs. But Roblox today has a stock market value of $74 billion versus $6 billion for Crocs. Footwear makers shouldn't be compared with online gaming companies, of course. But this particular footwear maker has 20% plus operating margins, or more than double those of Nike. B of A's Nardone says that North America has turned into a replenishment market for Crocs, but that overseas markets, especially China, India, and Western Europe, can keep overall revenue rising. The stock's sell-off, he reckons, can mostly be chalked up to tariff concerns, not falling demand. Whether the company can hold the line on Crocsflation will have a lot to do with where tariffs end up for Vietnam, a key footwear manufacturer. If the core clog goes from $50 to $52.99 and they can drive brand heat through pushing marketing, I don't think they're going to lose their core consumer, says Nardone. He rates the stock at buy with a price target implying a 27% upside. Moving into what happened and what will happen from the review and preview, which is in the Barrons dated July 7th. Streaming's steamy hit. Love Island USA, the dating competition show, is shaping up to be this summer's big hit. This past week, the Love Island phone app, which allows viewers to vote on the show's contestants, passed ChatGPT to become the #1 most downloaded program on Apple's App Store. New episodes of the reality show come out 6 nights a week on Comcast's Peacock streaming service. Season 7 premiered from Fiji on June 3rd, and the finale will air on July 13th. Contestants find partners and aim to be the last couple standing. The show has become a rare daily hook in the world of streaming, and the kind of appointment viewing largely lost in a post-linear TV world. Comcast took a risk in 2022 when it pulled Love Island from CBS, forcing viewers to watch via Peacock, which remains well behind Netflix, Disney Plus, and other streamers in terms of viewership. But Love Island is, no doubt, providing a boost. The Peacock app was #4 on Apple's App Store list of free downloads this past week. Netflix, by comparison, was #16. Peacock revenue increased 16% in the first quarter to $1.2 billion, as total Comcast revenue slipped 0.6% to $29.9 billion. There could be more good news for Peacock when Comcast next reports earnings on July 31st. The stock could use a boost. Shares of Comcast are down 3.3% this year versus a gain of 45% for Netflix. And that was reported by Angela Palumbo. What happened last week in the markets? Stocks opened on the July 4th week in record territory as the GOP raced to pass President Donald Trump's tax and budget bill by July 4th and sealed trade deals by July 9th. On Tuesday, Vice President J.D. Vance broke a Senate tie, sending the bill back to the House. The S&P 500 and NASDAQ Composite hit new highs on Wednesday, then again on the short Thursday session after the June jobs report beat expectations. The House passed the tax bill soon after. On the week, the Dow Industrials rose 2.3%, the S&P 1.7%, and the NASDAQ 1.6%. In companies last week, OpenAI agreed to a $30 billion a year data center leasing deal with Oracle. Canada dropped its digital services tax to restart trade talks, and the U.S. reached a deal with Vietnam. Trump said Doge should look into Tesla's subsidies after Elon Musk attacked the tax bill. Quarterly Tesla sales fell again. Renault took an $11 billion loss on its Nissan Motors stake. Moderna said its combo flu and COVID vaccine met its goals in late-stage trials. And JP Morgan Chase raised its dividend and approved $50 billion in buybacks after passing its stress test. In deals last week, the Justice Department settled its lawsuit against Hewlett-Packard Enterprises' $14 billion deal for Juniper Networks. Datadog replaced Juniper in the S&P 500. Paramount Global settled a defamation suit filed by Trump for $16 million. The lawsuit is hung over its acquisition by Skydance Media. Trump promised a TikTok buyer in 2 weeks, which China's Xi Jinping has to approve. And this week, on Tuesday, July 8th, the National Federation of Independent Business releases its Small Business Optimism Index for June. Consensus estimate is for a 97.9 reading, about a point less than in May, and that'd be right in line with a 51-year average of 98 for the index. On Wednesday, July 9th, the White House's 90-day reciprocal tariff pause ends. So far, the U.S. has announced trade deals with the U.K. and Vietnam, as well as a truce with China, giving more time for discussions. With more than 100 countries awaiting deals, President Trump recently said he wouldn't extend the deadline. The Federal Open Market Committee releases the minutes from its mid-June monetary policy meeting. At that meeting, the FOMC left the federal funds rate unchanged at 4.25% to 4.5%. The central bank has been on hold since December and looks set to take the summer off as another solid jobs report released this past week pushed traders to price in almost no chance of a rate cut at the late July meeting. And on Thursday, July 10th, the Department of Labor will report initial jobless claims for the week ending July 5th. Claims averaged 241,500 a week in June. That's up from 215,200 in January. By the numbers, 1 million. The number of robots deployed by Amazon.com in its warehouses, soon to exceed the ranks of humans. 500 billion. That's the number of tons of plastic waste produced globally each year, more than double the amount just 2 decades ago. 9.2%, the average return of S&P 500 dividend payers over the past 50 years, compared to 4.3% for non-payers. And $1.8 trillion, the current size of the federal student loan portfolio, with the average borrower balance at some $40,000. Moving on, in this week's Barrons magazine of July 7th, what's next in President Trump's tariff showdown? 90 deals in 90 days isn't going to happen by July 9th. What's likely? Continuing talks with large trading partners and more uncertainty. And this is reported by Reshma Kapadia. Trade week's almost here. Ahead of a looming July 9th deadline for higher tariffs on more than 100 countries, the Trump administration is likely to unveil a handful of preliminary deals, even as it ramps up pressure on other countries and confirms investors' hunch that tariffs are here to stay. Trade negotiations have been chaotic since the administration hit pause on the tariffs it unveiled on April 2nd in its bid to rapidly reorder the global trading system. The goal is to reduce the country's $1.2 trillion trade deficit, along with many non-tariff barriers. Having trouble keeping track? Well, you're not alone. Recent weeks have been marked with bouts of escalation followed by de-escalation, most famously with China, and more recently with the European Union, Canada, and Japan. The administration's vow to strike 90 deals in 90 days is out the window. Only a preliminary agreement with the United Kingdom that left 10% tariffs in place had been struck before Wednesday's announcement that Vietnam had agreed to 20% tariffs. That's twice what the export-dependent nation started with, but half the level threatened on April 2nd. The Trump administration also said it would levy a 40% duty on trans-shipped goods, targeting concerns that China was just going to use Vietnam to circumvent trade restrictions. Negotiations have been complicated by various factors, including domestic politics, such as elections this month in Japan, pushback from countries against U.S. demands that they take a harder stance on China, and uncertainty over the fate of industry-oriented tariffs. Some of those are already in place, others are pending. President Donald Trump this week reiterated the July 9th deadline, adding that he would send letters to countries informing them of their tariff rates. But analysts caution against the notion that the coming days will abate tariff uncertainty. Deals are likely to be preliminary, and sector-oriented tariffs could jeopardize fragile agreements. Even amid the uncertainty, the S&P 500 index has hit new highs. Investors are playing down trade risks after several instances in which the administration pulled back on escalatory moves. But trade veterans and analysts note that the uncertainty, which has left many businesses hesitant to invest and spend, could continue. On again, off again. I look at the template as the UK deal. We will agree on what we can, agree that we're not done agreeing on things, and keep working even while we paper the Phase 1 deal, says Neil Bradley, Chief Policy Officer at the U.S. Chamber of Commerce. Largely, 10% tariffs stay in place and they kick the can down the road on the other issues. Among larger trading partners that are contenders to get framework agreements are India, Canada, South Korea, and possibly the EU. The European Union, though each has had rough patches in the back and forth. Agreements could include deals to buy U.S. goods, natural gas, agriculture, weapons, and open markets for U.S. companies. India was early in the negotiating table and was prioritized by the administration, say trade experts. The country has a hefty share of trade barriers and a domestically oriented economy. However, Prime Minister Narendra Modi has tried to position India as an alternative for companies such as Apple seeking to diversify away from China. India could emerge with an agreement that includes a reduction in some tariffs on both sides, with the objective of a larger bilateral deal to come, says Mark Linscott, a career trade negotiator who worked in the Obama and first Trump administrations and is now a senior advisor at consultancy The Asia Group. The administration will also look to make an example of some countries where talks have been more difficult, analysts say. One example could be Japan. Trump this week described Japan as spoiled and bristled at its unwillingness to accept U.S. rice exports. He threatened a tariff rate of as much as 35%, higher than the 24% it was floated in April, on April 2nd. Here to stay. Most analysts expect countries to end up with at least a 10% tariff, 4 times what many started with. Malaysia, Thailand, and the Philippines could get hit with higher tariffs, 15 to 20% due to transshipment concerns, says Henrietta Treyes, Director of Economic Policy Research at consultancy Vita Partners. The wild card that companies and investors are most worried about are related to sector tariffs, imposed under Section 232 of the Trade Expansion Act for national security reasons. Aluminum, steel, and autos are already subject to sectoral tariffs. Investors have been waiting for the Commerce Department to issue duties on pharmaceuticals, semiconductors, lumber, and timber, among other industries. These sectoral tariffs have complicated negotiations as they target critical industries for America's biggest trading partners: autos for Japan, aluminum for Canada, lumber and timber for South Korea, pharmaceuticals for the European Union and India, and semiconductors for Taiwan. I would be very wary of giving up the store and not knowing what certainty you have in terms of what's coming on 232s, Linscott says of negotiators. The China hurdle. China faces the highest batch of tariffs at 55% after the latest fragile truce was reinstated, but pitfalls abound, with few of the structural issues yet tackled, and the administration still sitting on a list of companies for which it wants to restrict sales, along with plans to tighten export controls. China is also likely to get hit with industry tariffs. Any of these could push China to ramp up its own countermeasures, says a person with knowledge of the administration's thinking. Both sides have to be very careful in weaponizing their supply chains because it could have a very big impact. But the U.S. risks underestimating the counterforce China has in reserve to retaliate. There's also the potential for further de-escalation, especially if Trump accepts China President Xi Jinping's invitation to visit in September. China recently reclassified precursors to fentanyl as illegal, a move that could pave the way for the U.S. to ratchet back some of the 20% tariffs it imposed, citing China's role in the fentanyl trade. How long any of it lasts is anyone's guess. The next headline in Barrons this week: clean energy stocks get a late reprieve. NextEra, AES, EDP Renewables, and other big solar and wind developers could benefit from last-minute changes to the Republican megabill. By Avi Salzman. The golden age of government support for clean energy is over. A new, fraught era of energy policy has begun. The Republican megabill repeals much of the Inflation Reduction Act and guts its funding. Gone are $7,500 electric vehicle subsidies. Soon to disappear are credits worth 30% of the value of rooftop solar panels. The last-minute changes to the bill cracked open a window just wide enough for well-capitalized companies to slip through. Big solar and wind developers like NextEra, AES, EDP Renewables, and ENGIE should be able to keep receiving tax credits for the next several years. Those companies are the workhorses of the renewable energy industry, with enough solar and wind projects in the pipelines to power whole cities. Senator Lisa Murkowski, the Republican from Alaska, convinced Republican leadership to slip in a one-year delay to requirements that companies start construction on clean energy projects to receive grandfathered tax credits worth 30% of the project's value. Under current policy, they have 4 years to finish those projects once they've begun. The new language in the bill opens up the possibility that projects that enter service as late as 2030 could still receive credits, according to Morningstar analyst Tancred Fulop. It's much better than some feared, Fulop says. Murkowski also got the Senate to rescind an excise tax that could have decimated wind and solar developers by penalizing projects that rely on Chinese materials. The more benign language led clean energy trade groups to soften their previous statements on the bill, downgrading it from a disaster to just a disappointment. They vowed to keep up their work. The clean energy industry will keep building, keep hiring, and keep innovating, said Ray Long, president of the American Council on Renewable Energy. There's no question the work of building clean energy will only get harder from here. The industry is a multifaceted beast that won't universally benefit from the latest version of the bill. Domestic solar manufacturers, for instance, reacted angrily about the softening of the anti-China language. Shares of First Solar, the largest U.S. solar manufacturer, fell on Tuesday after the Senate bill was passed. Other segments of the industry already faced recession-like conditions. The rooftop solar industry alone has seen several bankruptcies in the past year. The U.S. offshore wind industry has stalled out just as it was getting going, leading several developers to cancel projects. Smaller solar and wind developers will face additional challenges. A decade of consistent policy has been replaced by what one solar developer called a solar coaster of changes, and all developers will face a maze of new rules designed to keep Chinese supplies and ownership out of the U.S. market, with some kicking in as soon as the bill passes. Some clean energy products are now being built in the U.S., helped by tax credits and the Inflation Reduction Act. But the precursor materials for these projects are largely made in China. Even renewable developers who are trying to use only made-in-America goods say it's impossible to make do without Chinese-made subcomponents like battery cells. There's no real way around it, says Kevin Smith, CEO of renewable developer Aravon, which buys only U.S.-assembled batteries. But for larger renewable developers, the rules appear to be just generous enough to allow them to continue production. They're benefiting from the fact that U.S. electricity demand is growing for the first time in decades because of AI data centers and other things. They're also the only option for near-term electricity generation. Trump loves coal and has ordered some old plants to keep operating beyond their closure dates, but no new plants are being built, and natural gas power generation is growing but faces a shortage of turbines that will slow its rollout. Nuclear, another technology that received favorable tax treatment in the Senate bill, historically takes a decade to build. There aren't many other options to fill that gap. We need a bridge, and that bridge has to come from renewables and storage, said NextEra CEO John Ketchum on the company's latest earnings call. Solar, batteries, and wind power are set to account for 93% of new electricity generating capacity in 2025. Companies are planning a wave of additional projects in the years ahead. There are over 130 wind and solar projects in the queue that are set to start operating in 2028 or later, according to the Energy Information Administration. Those projects have 32 gigawatts worth of power capacity, enough to power 10 million homes or so, or dozens of massive data centers. Tech demand for clean power shows no sign of flagging as those companies look to power AI data centers and adhere to low-carbon goals. An executive overseeing clean energy deployment at Google owner Alphabet said last month that the company is full steam ahead. We're really ramping up our procurement of wind and solar, said Michael Terrell, Google's senior director for clean energy and carbon reduction. If the clean energy projects can start construction on time, they can still get tax credits. Nuances in the tax rules give them an opening. Congress has historically allowed projects to qualify as under construction as long as the companies buy enough of the equipment they intend to use, a process known as safe harboring. In NextEra's case, the company said last year that it had safe harbored its project pipeline through 2029. NextEra, which also owns a regulated utility in Florida, has the largest renewables pipeline in the U.S., with projects all over the country. Several European power providers, like French utility Engie, have also invested heavily in building out renewables in the U.S., drawn by the generous tax credits. Full Up, the Morningstar analyst, thinks those European companies will keep building projects in the U.S. as long as they can get some clarity on tariff policy. He particularly likes German company RWE, which he thinks offer the best risk-reward potential due to its diversified power generation portfolio. The clock is ticking for renewable energy, but the latest bill shows little reason for panic. And now the cover story. ETFs are eating the world. How to invest. More than 700 ETFs launched last year, and the deluge shows no signs of letting up, by Ian Salisbury. A few months ago, you needed big bucks to tap the opaque world of private credit. Not anymore, thanks to the magic of exchange-traded funds. Firms like Apollo Global Management have long dominated the private credit space, traditionally requiring at least $250,000 or a high net worth to access its funds. But Apollo recently teamed up with State Street to launch the SPDR SSGA IG Public and Private Credit ETF. State Street, which is managing the fund, said it's democratizing access to private markets. Since it's an ETF which trades like a stock, anyone with an account at, say, Robinhood or Fidelity can now buy a sliver of Apollo's $600 billion private credit portfolio. Apollo's hardly the only firm using ETFs to drum up business. Wall Street has ETF fever. Firms are now packaging just about everything in the funds, including Bitcoin and other cryptocurrencies, leveraged bets on individual stocks like Nvidia, and even bonds that would pay out sharply if a natural catastrophe strikes. All of it has led to a Cambrian fund explosion. More than 4,000 ETFs are listed on the New York Stock Exchange, compared with just 2,400 individual stocks. Fund companies launched more than 700 ETFs last year, including 33 that track cryptocurrencies, more than 130 buffered ETFs, and dozens that magnify bets on indexes like the S&P 500 or stocks like Nvidia and Palantir Technologies. Most of the new ETFs are small and niche, holding less than $100 million in assets each, and dozens of ETFs shut down every year after failing to catch on. But the industry is still raking in assets. ETFs have taken in over $2 trillion of net inflows over the past 2 years, bringing total assets to nearly $11 trillion. They now hold 1 out of every $3 invested in long-term funds, excluding money markets. Some of the money flowing into ETFs has come out of traditional open-end mutual funds, which have lost $1.2 trillion due to outflows in the past 2 years, while investors are flocking to ETFs for their tax efficiency and other advantages. ETFs are also tackling mutual funds where it really hurts: active management. More than $1 trillion now sits in active ETFs that trade stocks and other securities. Cathie Wood's ARK Innovation ETF is a prominent example, but there are now more than 1,300 active ETFs, including funds from big companies like T. Rowe Price Group, GMO, and JP Morgan Chase. Bond manager PIMCO alone has amassed $31 billion in fixed income ETFs, and the deluge shows no signs of letting up. President Donald Trump and congressional Republicans are laying the groundwork to deregulate financial markets, make crypto mainstream, including stable coins from companies like Circle Internet Group, and open the $12 trillion world of private equity and credit to the broader public. Hundreds of new ETFs are awaiting a go-ahead at the Securities and Exchange Commission, including around 70 new crypto ETFs and plenty of active stock-picking ones. The flood of ETFs raises questions for investors. Should you buy any of the new ones, stick with basic index funds, or use a mix? With so many products, there's a lot to learn, especially about novel funds that employ aggressive strategies or aim to expand the ETF empire to new frontiers. Here's how to get the most out of ETFs and avoid the pitfalls. What makes them so popular? Launched in the early 1990s, ETFs were initially designed to track popular stock indexes like the S&P 500. The $600 billion SPDR S&P 500 Trust, launched in 1993, remains one of the largest ETFs, and most of the industry's assets are still concentrated in funds that track major indexes, sectors, and foreign markets. The top 4 ETF issuers, Vanguard, BlackRock's iShares, Invesco, and State Street, control $9 trillion in assets, staking a commanding lead over everyone else. Just below the giants is a long and growing tail of ETFs snaking through every market crevice. Investors who want exposure to oil, for instance, gravitate to the U.S. Oil Fund. The SPDR Gold Shares is the leading choice for the precious metal. In crypto, the iShares Bitcoin Trust ETF has become the biggest of the bunch, holding $75 billion in assets. Regardless of what they own, most ETFs owe their popularity to convenience, low costs, and tax efficiency. A big difference from mutual funds is intraday liquidity. You can buy or sell ETFs like a stock. Orders for mutual funds, by contrast, are priced once at the 4 p.m. market close. Liquidity is a big reason ETFs are so widely used by hedge funds, and it can be helpful if there's a big market move and you want to sell a position quickly. Crucially, most ETFs are more tax efficient than mutual funds. While the details are complicated, ETF portfolio managers are rarely obliged to sell underlying shares of a stock or other asset. Instead, they continuously work with trading firms to swap holdings and shares as needed. Under normal market circumstances, the process keeps a fund's net asset value aligned with its holdings, avoiding the added complexity of closed-end funds, which often trade at wide discounts or premiums. These arcane details of ETFs have big tax consequences, since security swaps, unlike sales, don't register capital gains to a fund. That means ETF investors typically don't have capital gains tax bills until they sell their shares, avoiding a big hassle and expense of traditional mutual funds, which have to distribute a portfolio's gains each year. ETFs can also be extremely low cost, though fees creep up for products using bespoke strategies. The average annual management ETF fee is below 0.16%, according to Morningstar. That's less than half the 0.4% average charged by mutual funds. Among active stock ETFs, fees average 0.42%, still well below the 0.57% average for active equity mutual funds. Should you own active ETFs? Firms launched more than 500 active ETFs last year, accounting for 70% of new launches and 25% of flows, according to research firm TrackInsight. Many of the new products involve niche strategies such as buffered ETFs, which use options to give investors exposure to the stock market while capping gains and losses. Firms like Fidelity and T. Rowe Price have dabbled in active ETFs, but they remain quite small. T. Rowe Price Capital Appreciation Equity, the firm's largest ETF, with $4.6 billion in assets, hit the market in 2023. It was designed to build on the success of the storied T. Rowe Price Capital Appreciation Mutual Fund, which remains an order of magnitude larger, with $66 billion. Fund companies don't want to cannibalize their mutual funds with lower-cost ETFs, but they may be now more inclined to launch copycats, thanks partly to an obscure patent expiration. Vanguard, which held the patent until 2023, no longer has a lock on creating ETFs by simply creating an additional share class of an existing fund. Nearly 60 fund firms have filed with the SEC to launch funds following Vanguard's approach, with approvals expected to start this year. There's no question the ETF share class structure will be a game changer, said Nate Garachi, an investment advisor and president of the ETF store. Whether to own an active ETF comes down to the same issues that plague mutual funds. The vast majority underperform their benchmarks. Consider the rise and fall of Wood's ARK Innovation ETF, known by its ticker ARKK or ARK. Soaring more than 150% in 2020, the fund raked in assets, reaching a peak of $28 billion. But as money flowed in, Wood gravitated to larger cap stocks. Performances fizzled, and the fund lost 75% of its value in 2021 and 2022, and it's underperformed the NASDAQ composite by more than 100 percentage points over the past 5 years. While the NASDAQ's 5-year cumulative return is 108%, ARK's is minus 2%. ARK Investment Management President Tom Stout says changes in the fund's composition were the result of mergers in tech and gains for ARK's holdings, bonds, Bitcoin, and alternatives. Beyond stock ETFs, the rest of the industry's assets sit in everything from bonds and commodities to crypto and other alternatives. Bond ETFs now hold nearly $2 trillion in assets. The biggest ones, Vanguard Total Bond Market and iShares Core U.S. Aggregate Bond, track the U.S. market, holding treasuries and other U.S. government bonds, along with investment-grade corporate debt. They can be solid core holdings for investors who use bonds to diversify their portfolio. Fixed income ETFs also delve into everything from high-yield junk to preferred securities and municipal bonds. Several of them have a long record of beating indexes. Top performers from PIMCO, for instance, include PIMCO Active Bond and Intermediate Municipal Bond Active. One can also find solid ETFs for Treasury inflation-protected securities such as JP Morgan Inflation Managed Bond and in high yield with a Van Eck Fallen Angel High Yield Bond. Granted, bond ETFs can have structural flaws. Many individual bonds trade infrequently, especially outside highly liquid Treasury markets. As a result, the ETFs, which may own thousands of securities, rely on mathematical models to estimate their underlying value in real time. In times of market stress, ETF share prices and theoretical values have diverged. In March of 2020, during the early days of COVID, the $30 billion iShares iBox dollars investment-grade corporate bond ETF closed more than 5% below the estimated value of its portfolio during the trading day. If something like that happens again, it's best to wait until the market stabilizes, which usually happens quickly, before buying or selling, says Aniket Ulal, head of ETF research at CFRA. The models can be a little bit stale, he says, and share prices will eventually converge to underlying holdings. Similar issues arise in ETFs aiming to track commodities, crypto, and other alternatives, as their markets aren't always liquid or transparent, and ETF companies use workarounds. Commodity ETFs, for instance, generally hold futures contracts to track things like oil and copper. In most cases, futures substitute for the real thing because it isn't practical to own, say, millions of bushels of corn. Commodity futures are imperfect, though, because prices for oil futures often drift above or below spot prices. The USO oil fund returns frequently deviate from oil spot price returns. In 2020, COVID-fueled dislocations led near-month oil futures to briefly trade at negative prices. USO lost 75% of its value in the first 5 months of that year. USO experienced a black swan event in 2020, says Katie Rooney, Chief Marketing Officer at USCF Investments, which is the fund's sponsor. Nevertheless, we made an extra effort to communicate with investors at the time, and USO continued to meet its investment objective. One way around the futures problem is for a fund to be structured like a trust and take ownership of the commodity. While it doesn't work for commodities like oil or copper, it does for gold. The $101 billion SPDR Gold Shares owns gold bars sitting in a vault, and the ETF's price directly corresponds to the value of the bullion. Crypto is a new and untested class of ETFs. The first wave used futures and other derivatives to track Bitcoin, but the SEC in 2024 allowed ETFs to track spot prices and own tokens directly in digital vaults, creating Bitcoin trusts. If you're going to invest, stick with the largest and most liquid ETFs backed by blue-chip firms. That would include the iShares Bitcoin Trust and the Fidelity Wise Origin Bitcoin Fund. Crypto ETFs are rapidly moving beyond Bitcoin. The second largest token, Ethereum, now has 20 ETFs tracking its moves, including funds like iShares Ethereum Trust and Grayscale Ethereum Mini Trust. More crypto ETFs are seeking approval from the SEC, tracking tokens like Litecoin, XRP, and Solana, as well as more playful ideas like Dogecoin, Bonkcoin, and even President Trump's personal meme coin. Not all of these will see the light of day, but a Trump-backed SEC is expected to be far more amenable than the agency was under President Joe Biden's SEC chair, Gary Gensler. I think you'll sense SEC staff trying to work with the ETF industry to facilitate new types of products, to facilitate innovation, says Brian Murphy, a former SEC attorney and partner at Stradley Ronan. Private assets are also showing up in ETF wrappers, including venture-backed companies that have yet to go public. The shares private-public crossover ETF, for example, is nearly 10% of its assets in Elon Musk's SpaceX, along with stakes in private companies such as Klarna and Anduril. Bear in mind that these ETFs provide watered-down access to private securities. Industry rules limit ETFs to holding 15% in private, illiquid assets, and the funds tend to be padded with publicly traded stocks or other securities. The shares ETF has more than 80% of its assets in familiar big tech names like NVIDIA and Oracle and Meta Platforms. One risk? Private assets are opaque and their values are based on educated guesses rather than broad market price discovery. The shares ETF's website pegs SpaceX's value at $185 a share, the same as in December despite a public feud between Musk and Trump, which hit Musk's other big company, Tesla, hard. The ETF stakes in SpaceX and other private holdings are also held in a special purpose vehicle, which charges fees that aren't disclosed to investors. We will price SpaceX or Klarna up or down when there's clear evidence the price has changed or when a consensus price event, such as a tender offer, emerges, says fund manager Joel Schulman. Whether ETFs can be jury-rigged for private investments is debatable, and investors are taking a leap of faith about how they might trade in a crisis. The SPDR SSGAIG Public and Private Credit ETF has a contract with Apollo as a trading partner, guaranteeing that the ETF will always have at least one place to buy and sell. Whether Apollo would buy back the ETF's assets at full price or a deep discount in a crisis situation isn't known. As much as I champion ETFs, not every asset class belongs in an ETF, and I would suggest maybe private credit could fit into that category, says Geraci. And with that, we've come to the end of our reading of Barrons magazine with an issue date of Monday, July 7th of 2025. This is your reader, Eric, saying be well, be safe, look after each other. Hope you had a great 4th. Bye for now.